It's still in the conversation because of the high performance perp DEX narrative, the ZK rollup architecture, the real trading volume on the platform, the revenue to buyback model, and the simple fact that any protocol competing in the on chain perpetual future space continues to draw attention. If this is useful, hit the like button, subscribe if you haven't already, and leave a comment with your honest take on it. I actually read them. Looking at ratings and signals, a lot of the technical scanners and community sentiment have leaned cautious to mixed for an extended period. You will see a mix of hold and mild sell readings, especially from tools that track the longer term trend and the position relative to key moving averages. Funding and open interest in the derivatives markets have flipped around, but the short term outlook from pure chart based sources remains defensive until price can reclaim and hold above recent resistance levels with convincing volume. There is more coverage for lighter than for lower ranked names because of its ranking and perp dex role, but the consensus from technical and sentiment tools has stayed measured rather than strongly bullish. On the technical side, the bigger picture remains a clear long-term corrective structure from the higher levels reached after launch. Price has spent extended periods making lower highs and lower lows, with recent action testing support near multi-month levels. Short-term bounces have occurred but have consistently failed to reverse the larger structure. Momentum indicators have been mixed to weak on the higher time frames, often hovering in neutral to oversold territory without producing strong sustained recoveries. Moving averages on the daily and weekly still lean bearish to neutral, and volume has been relatively subdued outside of occasional spikes. Short term, it feels more like a weak consolidation or bounce inside a larger corrective structure than a clean trend reversal. You can argue there is some resilience when price holds the recent lows, but the overall structure still looks heavy. That's the classic trap setup. The technology is real, the platform continues to process trades, but the market keeps assigning it a lower valuation while attention stays elsewhere. Retail often gets caught here, buying the CEX speed on chain PEP's argument while the larger trend remains downward or sideways. Here's the real debate. Is LIT actually undervalued at these levels, or is this a value trap after the post-launch decline? One side points to the ZK rollup design for high-speed verifiable trading, the real perpetual volume, the fee revenue directed to buybacks, the distance from previous highs, and the idea that high-performance on-chain perps infrastructure could re-rate if capital rotates back into DeFi trading narratives. They argue that if volume stays robust and the buyback mechanism continues, these levels could look reasonable in hindsight. The other side says look at the chart and the market structure. Many perp decks and trading tokens that peaked during strong narrative runs have struggled to hold value once attention faded. Volume and momentum have been soft for long stretches. Competition in the on-chain perp space has intensified, and the market has consistently treated LIT as a lower priority name despite the underlying activity. What's going on with Lighter right now? The chart has been under pressure for a long stretch. Sell signals keep appearing on the higher time frames, and yet some people still argue this thing is somehow undervalued at these levels. How do those two views even sit together? Let's talk about it. Lighter is a decentralized perpetual futures exchange built as a custom zero-knowledge rollup on Ethereum. It aims to deliver centralized exchange-level speed and performance while keeping execution verifiable on-chain, with a focus on low or zero fees for retail traders and cryptographic proofs for every trade and liquidation. LIT is the native token used for governance and aligned with protocol revenue through buybacks. It currently ranks near the top 70 by market cap, with a circulating supply of 250 million out of a 1 billion maximum, and the price has been trading near the levels you're seeing after a decline from previous highs. Short term, the picture still looks more consolidative and reactive than impulsive. You need to see stronger volume and a clean break of the recent resistance cluster before the short term bias flips with any real confidence. Longer term, it comes down to whether Lighter can convert its high performance perpetual exchange into sustained demand and relative outperformance for the LIT token. That's the only path that turns these levels into something more constructive instead of just another extended consolidation or grind lower. Risks are meaningful. Volatility is still present. A broader risk of move in crypto or continued rotation away from mid-cap DeFi trading tokens can pressure the price further. Downside remains open if the recent support zone breaks and the downtrend simply continues. Retail traders love the long-term high-performance perp DEX story and end up holding through multi-month or multi-year underperformance. Liquidity is solid relative to pure micro caps, but still thinner than the very top names, so larger moves can still happen quickly. There's also the structural risk that comes with any trading protocol. The narrative has to keep generating real volume, real revenue, and relative demand, or the token simply fades under competition and shifting attention. Nobody knows which way this resolves. The chart is still fighting the technology narrative, the platform continues to process real trading volume, and the market remains selective about which on-chain PEP stories it rewards. So the real question is simple. Is this the kind of project that can finally break out of its long underperformance and re-rate higher? Or are we just watching another established trading token settle into a prolonged period of low relative interest while people argue about valuation? Bull case versus bear case is fairly clear. Best case, broader market risk appetite returns to DeFi trading. Lighter continues to grow perpetual volume. The buyback model supports the token and price manages to reclaim key resistance levels and start building a higher base. In that scenario, you could see a meaningful recovery toward previous intermediate highs over a longer horizon. Worst case is the opposite. Volume stays muted relative to peers, relative performance continues to lag, and the downtrend simply grinds lower toward new cycle lows. In that scenario, the undervalued talk just becomes background noise while price continues to underperform.